Your stop loss keeps getting hit, and right after it hits, price reverses exactly where you thought it would go. You were right about the direction, you were right about the target, but you got stopped out anyway. This has happened to every single trader watching this video, including me. And for years, I thought it was just bad luck. It wasn't. It was because I was placing my stop loss in exactly the place smart money was hunting. Today, I'm going to show you why this happens and exactly how I use volume profile and RTM to place my stop loss where smart money can't reach it. Hello everyone, my name is Marjan and I've been trading for 8 years, self-taught from zero. I trade Forex, crypto, and gold using institutional order flow and volume profile. And the single biggest improvement I made to my trading wasn't finding better entries. It wasn't even better risk management. It was learning where to place my stop loss. Because a perfect entry with a wrong stop loss is a losing trade. And a good entry with the right stop loss is a winning trade, even if price dips against you first. Let me explain what's actually happening when your stop loss gets hit. Most traders place their stop loss in one of three places: just below a support level, just above a resistance level, or a fixed number of pips away from their entry. And all three of these are wrong. Here's why. Smart money, institutions, banks, large funds, they need a liquidity to execute their orders. When a hedge fund wants to buy 500 million of an asset, they need sellers. And where are the sellers? Right below your stop loss. Your stop loss is a sell order. When it gets triggered, it creates the liquidity that institutions need to buy. This is not conspiracy theory. This is market mechanics. Institutions actively look for clusters of stop losses because that's where the liquidity they need is sitting. And the most predictable clusters of stop losses are right below obvious support levels and right above obvious resistance levels, exactly where retail traders place them. So, what's the solution? You need to place your stop loss where the institutional orders are, not where retail traders put theirs. And that's exactly what volume profile and RTM tell you. Let me show you exactly what I mean on a real chart. This is Bitcoin, 1 hour time frame, and I want you to look at this red box at the bottom of the chart. This is a demand zone, an area where buying pressure has been strong. Price has touched this zone multiple times: June 19th, June 11th, June 18th, and also June 19th. Every single time, price came down to this zone and reversed. Now, here's the question most traders get wrong. Where do you put your stop loss if you're going long from this zone? Think about it. Most traders look at this and think, put the stop just below the bottom of the red box, right here. It seems logical. The zone holds. Price reverses. If price breaks below the zone, the trade is wrong. That's simple. It's wrong. Look at what the volume profile is telling you. See these purple bars on the left and right side of the chart? That's your volume profile. And look at this zone. There is actually a significant volume here. This is an HVN, a high volume node. Institutional orders are sitting inside this zone. So when price comes down here, institutions are absorbing the selling. They're buying. They're protecting this level. Now, here's the critical detail. The bottom of this red box, where retail traders put their stop, is still inside the HVN, still inside the zone of institutional protection. So what happens? Price comes down, touches the bottom of the red box, triggers all the retail stop losses sitting there, collects that liquidity, then with all those sell orders absorbed, price reverses back up. The retail traders got stopped out. The institutions got their fill. This happened on June 18th and 19th. Look at the chart. Price dipped below the bottom of the red box, right where the stops were, then immediately reversed. So where should your stop actually go? Below the entire HVN, not at the bottom of the red box, below the entire demand zone, where the volume completely disappears, where the LVN begins. Because if price breaks through the entire HVN, through all of that institutional buying, then the setup is genuinely invalid. The institutions have been overwhelmed. The demand zone has failed. That's when you want to be out, not before. And here's the beautiful thing about placing your stop below the full HVN. To hit your stop, price would have to push through hundreds of millions of dollars of institutional orders. That almost never happens on a genuine reversal setup. Your stop is protected by the same orders that are driving price back up. This is not about having a wider stop. This is about having a smarter stop. A stop that's placed where the market structure says the trade is wrong, not where retail convention says to put it. Now let's look at a Forex example. This is NZDUSD 1 hour time frame. And this is a trap that caught a lot of traders. Look at this red zone at the bottom of the chart. This looks like a textbook demand zone. Price came down here, bounced, came down again, bounced. A classic RTM setup. Most traders see this and think this is a strong buy zone. Entry here, stop just below the red box, and they got destroyed. Here's exactly why. Look at the volume profile on the left side of the chart. Do you see these purple bars? Now, look at where the red demand zone is sitting. Almost no volume there. This is an LVN, a low volume node, a liquidity void. There are almost no institutional orders defending this zone. It's not a zone of strength. It's a zone of emptiness. Now, look at where the POC is, our point of control. Way up here in that green zone in the middle of the chart. The market's fair value is up there, not down here. Not at this demand zone. Price was far below fair value and in a low volume area. That's not a buy setup, that's a trap. Now, look at what happened. Price came down into the red zone. Retail traders bought. Stop losses went just below the red box, right there, and price did exactly what an LVN does. It flew straight through. No resistance, no institutional buying to hold it. The stops got hit And then only after the liquidity was collected, price reversed back up toward the POC. Now here's the lesson. In RTM, we look for demand zones, but not every demand zone is equal. A demand zone sitting on an LVN with no volume profile support. This is a weak zone. A demand zone sitting on an HVN with institutional volume behind it is a strong zone. This NZDUSD example shows you a weak zone, but the Bitcoin example I showed you before, that was a strong zone. The difference is what the volume profile tells you about what's behind the zone. Before you enter any RTM zone, look at the volume profile. Is there an HVN supporting it? If yes, the zone has institutional backing. Your stop below the HVN is protected. And if no, if it's sitting on an LVN, be very careful. Either skip the trade entirely, or if you do it, your stop needs to go much further down, below the next HVN you can find, not below the market demand zone, because a stop below an LVN zone is a gift to smart money. It's exactly what they're hunting, and this chart proves it perfectly. Now let me give you the complete system. How I combine volume profile and RTM to place every single stop loss. Step 1. Identify the trade direction using the POC. Is price above or below? Which way does institutional gravity pull? Step 2. Find entry using RTM. Where is the nearest order block? In the direction of the POC? That's your entry zone. Step 3. Find the stop loss level. Look at the volume profile on the other side of your entry. Find the nearest HVN. Your stop goes just beyond that HVN. Then check, is there an RTM order block in the same area? If yes, then perfect. Double protection. Your stop is behind both an HVN and an order block. Step 4. Calculate the risk reward. From your entry to your stop, that's your risk. From your entry to the next HVN or POC in the trade direction, that's your reward. If the ratio is less than 1 to 2, skip the trade. Wait for a better setup. Step 5. Execute and manage. Once price moves in your direction and clears the nearest LVN, move your stop to break even. You now have a risk-free trade. Let the market take you to your target. This is not complicated, but it requires patience, because the right setup with the right entry, the right stop, and the right target only appears a few times a week. Not every hour, not every day, a few times a week. Now gold. Same principle, different market. This red zone at the top is the POC, maximum volume, institutional selling zone. Wrong stop just above the red box. July 2nd, price spiked above it, hit all the stops, then collapsed. Right a stop above the LVN, above where volume disappears. That spike never reached it. Traders with the right stop stayed in the trade. That's it. Same system, every market. Before we finish, 3 mistakes I see constantly with a stop loss placement. Mistake number 1. Placing your stop at a round number. Round numbers are the most haunted levels in the market. 1.1 on Euro USD, $30,000 on Bitcoin, $2,000 on gold. Smart money knows retail traders cluster stops at these numbers. Never place your stop at a round number. Place it just beyond the nearest HVN, which almost never falls exactly on a round number. Mistake 2, placing your stop too tight. A stop that's too close to your entry will get hit by normal price noise before the trade has time to develop. Your stop should be behind a structural protection, an HVN or an order block, not 1 pip below your entry. Mistake 3, moving your stop loss in the wrong direction. When a trade is going against you, never move your stop further away to give it more room. This is how small losses become account-destroying losses. If price is approaching your stop and you're not sure, close half the position, don't move the stop. Now here's the action step right now. Open TradingView, pull up your last 5 losing trades, find where your stop loss was. Now, at volume profile, look at what was at your stop loss level. I guarantee in most cases, your stop was in an LVN. Almost no volume, no protection. It was easy to hunt. Now, look at where the nearest HVN was. That's where your stop should have been. Do this exercise for every losing trade you've ever had, and you'll understand exactly why they happened and exactly how to fix it. If you found this useful, subscribe. Every week, I publish institutional order flow and volume profile analysis. Turn on notifications and drop a comment. Has your stop loss ever been hunted right before price reversed? Tell me about it below. I read every single comment. See you in the next video.